It's long-term what?
Okay, let's get started. When it comes to long-term care insurance, it's a two-way race. Traditional policies and hybrids. Remember those Saturday morning cartoons where the Coyote tries to catch the Roadrunner in a world ruled by cartoon physics?
Beep, beep.
Today, I'm comparing traditional long-term care policies with Wile E. Coyote, constantly chasing after hybrid policies, the Roadrunner of long-term care. It's not a perfect analogy, but it's largely true and makes an otherwise dry topic unboring. Now, you don't need to know every difference between these policies, just like you don't need to know the difference between a V6 and a V8 when you're buying a car, but it can help you make a better choice for your situation. Related, our business is helping planners like you to buy long-term care insurance. We work with all the top companies and can help you find the policy that fits you best. Visit longtermwhat.com or visit the link in the description. So let's start with the basics. Traditional policies started in the 1960s. They're pretty straightforward. You pay premiums and you get benefits when you need care. These are sometimes called standalone or pure long-term care insurance. Hybrids came along in the late 80s. They combine long-term care coverage with life insurance. That's why they're called hybrids. You might also hear them called linked benefit and asset-based policies. Now, I'll explain what this means and why you should care. The biggest difference between these two is something called cash value. Think about cash value in terms of finding a place to live. You can either rent or buy. Renting is like a traditional policy. You pay, but when you move out, you've got nothing to show for it. Buying, on the other hand, is like a hybrid. You get equity or cash value. Traditional policies work like your auto or homeowner's insurance. You pay in, and if something happens, you get benefits. But if you don't use it, you lose it. Hybrid policies are different. They have cash value. Even when you never need care, they win here.
Beep, beep.
Here's how hybrids work in real life. If you do need care, it pays benefits. If you quit the policy, you can get some money back. And if you never need care, your family gets money back. Either way, someone's getting a check, which leads us to the next section, refunds. With a traditional policy, if you don't use your benefits, the money you spent on premiums is typically lost, like most insurance. Hybrids, on the other hand, are different. If you don't use your benefits, the premiums you paid are returned to your spouse or kids. Wait, so insurance is
For free!
for free? Well, sort of. You could have invested that money instead and earned interest, so it's not exactly magic. But still, getting your money back if you don't use your benefits, that is a huge crowd favorite. And another win for hybrids.
Beep, beep.
Let's talk about benefits. Traditional policies reimburse you for long-term care expenses, like most insurance you know. You or your care provider submit receipts to get paid back. Hybrids work differently. For most of them, you get a check. No receipts required. You can use the money however you want. No oversight. You can even pay family members to provide your care. Hybrids with this cash indemnity give you a lot more flexibility.
Beep, beep.
Let's talk about premiums. With many traditional policies, you pay for your lifetime, but the insurer can raise your premiums later if they underpriced it. That did happen in older policies, but today it's much less likely. But still, insurers finally got better at math thanks to decades of data. Hybrids, on the other hand, come with a guarantee. Your premiums will never go up. Again, another hybrid win.
Beep, beep.
Let's discuss the costs between these two options. I've made a strong case for hybrids so far, but traditional policies can often be less expensive. Yes, I know. I like rooting for the underdog as well. Less expensive makes sense since they come with fewer perks. You might see savings in three ways: lower premiums, greater tax advantages, and they often qualify as partnership policies, which help shield your assets if you ever need Medicaid. See the link in the description for more info on this. Now, comparing these two purely on cost can be tricky. It's like comparing a camera to a smartphone. Both take pictures, but one does a lot more. So what's the best choice for you? Well, if you want money back, if you never need care, flexible benefits, and guaranteed premiums, a hybrid policy might be the right fit. From an insurer like Nationwide, One America or Securian. If you're looking for simple, no-frills, long-term care coverage at the lowest cost, a traditional policy might be your best bet from a company like Mutual of Omaha, Thrivent, or NGL. I'm Jesse, and this is long-term... What? We work with all the top carriers to help you compare policies, skip the jargon, and find something that fits you. If this helped, share it with someone who needs it. Like it so more people see it, and subscribe for more unboring long-term care tips. For personalized insurance quotes or to learn more, visit longtermwhat.com or see the link in the description. Thanks.